Federal Reserve Bank of Cleveland President Beth Hammack said this week that persistently high inflation is her bigger worry, not unemployment, not slowing growth. She sees no conflict between the Fed's dual goals right now because the labor market is holding and consumer spending has not cracked. That is not a reassuring message. It is a signal that U.S. rate cuts are not coming as fast as markets hoped, and that gap has consequences for every Canadian with a mortgage, a car loan, or a credit card. Canada and the United States share the deepest bilateral financial relationship in the world, and interest rate policy does not stop at the border. When the Fed holds rates higher for longer, it puts pressure on the Bank of Canada to stay cautious as well. Cut too aggressively below U.S. rates and the Canadian dollar weakens, which makes everything imported, food, fuel, electronics, more expensive. That is the bind the Bank of Canada is already navigating. The Bank of Canada has moved faster than the Fed in this cycle, cutting its policy rate several times while the Fed has stayed on hold. That divergence is already weakening the Canadian dollar against the US dollar. A weaker loonie directly raises the price of goods Canadians import, which feeds back into the very inflation the Bank of Canada is trying to cool. Hammack's comments suggest that gap between the two central banks may not close anytime soon. For Canadians renewing a variable rate mortgage or shopping a new fixed rate, the Fed's posture matters because Canadian bond yields move with US yields. If U.S. long-term rates stay elevated due to sticky inflation expectations, Canadian 5-year fixed mortgage rates face a ceiling on how far they can fall. Renters are not insulated either. Landlords financing new purchases or renewals pass higher carrying costs through to rents over time. Hammack's specific framing is worth unpacking. She is not saying the economy is in trouble. She is saying conditions are good enough that the Fed does not need to rush relief to borrowers. Low unemployment and resilient spending give the Fed room to wait. From the Fed's perspective, that is discipline. From a Canadian household's perspective, it means the interest rate relief many have been counting on is arriving more slowly than the calendar suggested a year ago. Watch the U.S. Consumer Price Index releases each month. That is the number that will either confirm Hammack's concern or ease it. Watch the Canadian dollar against the U.S. dollar. Sustained weakness below 72 cents signals the rate gap is biting. And watch the Bank of Canada's next rate decision for any language about the pace of future cuts. If they slow down explicitly because of U.S. conditions, that is the story getting bigger. If this breakdown was useful, subscribing keeps this kind of analysis coming without the noise.